Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. On the occasion of Dussehra, we greet each one of you, and special greetings go to the CEO of Value Research, Dhirendra Kumar.
Thank you.
Special because he's going to throw light on a lot of stuff which on financial terms we do which are wrong or which are evil because we are blocking our financial blessings. So what are those five, as we were discussing, it could be more, blockings that we have in our lives which are hindering our financial goals?
There are just too many, but if I have to summarize or highlight five of them, I would say that the foremost is not getting started early enough.
Okay.
The procrastination, the delay. When we start earning, we think that we have to be little well off to get started. I think that is one of the biggest sin. That's one of the evil which we should overcome. I think investing or being well off, getting started with a small money. If you can do it with putting it in your piggy bank or putting it in the doing a recurring deposit. Don't get sophisticated about it. Keep first to invest you need to save, and saving is a habit. Saving is not a matter of a scale. If you make 5,000 rupees, your intent or ability to save 250 rupees every month is crucial. If you make 5 lakh rupees, saving that 25,000 rupees is important.
So what Dhirendra in a nutshell is saying that get rid of abhi khao piyo, baad mein dekhi jayegi attitude. What you need to do is start early enough. So that is sin number one that you need to get rid of. Dhirendra, sin number two.
Sin number two, I think, the belief in fixed deposit, fixed income. Once you decide to invest, it's not bad, it's important. You need fixed income. But complete fixation with fixed income is injurious because thinking about equity and the myths that prevail around it,
right,
that equity shares are risky. It's a speculative thing. Yes, at some level it is risky, it is volatile, it can be risky, but it's the orientation which makes it different. When you invest in shares, when you invest in equity, you become the owner, and that is the only way to beat inflation because you get connected to the real economy. Companies produce goods and services which gets adjusted with the inflation.
Right.
So that's myth number two. I would say sin, that complete fixation, all your money completely in fixed income will be injurious to your health, because injurious to your financial health, because you will not be able to beat inflation. Sometimes you will underperform inflation. So effectively your money is going down. So get rid of that.
Okay. So I'm just recapping as you were saying, Dhirendra, start early. Don't get fixed to fixed deposits.
Yeah.
And third is that you should be saying, I know we discussed it, but
that insurance is not investment. Most people get carried by the notion because they perceive it safe. They don't ask question, and they mix insurance and investment, which is a bad thing. Get insurance,
right,
but don't consider insurance as an investment, because insurance doesn't really combining the two, you get the worst of two. Insurance is a very crucial goal, is a crucial need, and you should look at it as buying protection and paying for it, and that's all there to it. For investment, look at it objectively, your short-term investment, medium-term investment, long-term investment, and it should be done independent. The moment you try and mix it up, you get the worst of both.
Okay, so what people generally say, LIC kara lo, that's not good enough.
Life insurance is you should get life insurance, but don't think of it as an investment.
Yeah, a lot of ULIP agents, etc., keep
Insurance
saying
agents,
that maximize a fund or something in the garb of that. So would you like to say something on that?
I would say that every investor, it is your money. Ask question. You will pay this much. What will you get? You have to basically ask 3 questions. What you pay, what you get, and what is the cost, and try and split it. That what do you get, then you will be told that you are getting this and you are getting this. So what is the benefit? Then you can actually ask yourself some question, that what is being told Is it a realistic thing? You can figure it out. The moment you get into a mindset of breaking something into what you pay, what you get, and what's the cost, and what is in it for him, the person who is selling it, you will figure out, you will decode, and you'll get smart.
So we've discussed three
of them.
How should I put it? Sin is the right word, or should
No,
we say
sin
the
is not a right
financial
word. I would
demons
say,
in your life?
no, we are just talking of sins in the context of Dussehra.
Yeah.
But it is not a sin. It is lack of understanding. It's a mistake.
Yeah.
And it's a mistake, if you correct early, it'll have a payoff. It's a small mistake, and that becomes a habit.
Yeah.
So if you fix it early, you'll get more rewards, because most investments, you just need time.
Okay. Moving on to the fourth mistake that you need to avoid so that you don't damage your long-term wealth is, Vijay?
Too good to be true. Most people, I would say that this is one of the, if I have to really put it in chronology or in order of priority, this should have been the second one.
Okay.
Because most people fall for something and hurt themselves when they fall for something which is too good to be true, and getting carried by the noise, not asking question. All the Ponzi scheme in which investors lost their capital, not only return or the opportunity cost, but they lost their capital. So too good to be true, it is unlikely to be true. Keep off. We keep coming across all the kind of rackets and frauds that happens. You have to ask 2-3 things. As I was telling about in the context of insurance, what do you get? What do you pay? And if you are going to get too much, if you are going to get plenty, then you have to necessarily get suspicious. There is no such thing as too good to be true. And when you get something phenomenal, don't get carried by the noise. You will have a friendly neighborhood, a relative, a friend, a colleague, or somebody who will say that he did it and he's the evidence. He has experienced it. Maybe that is the start of the con job. Keep off from that. Okay.
And also remember, what you sign today determines where your child goes to study in future. It depends on, the paper that you sign is extremely important.
Yes, saving is not a very casual thing. Saving and investment.
Your retired life depends on this.
Real life, situations depend on that. How your children go to school, or how their college will be taken care of, how you retire, whether you are able to build your house in time.
Correct.
So whether you'll be able to, have a peaceful retirement and you don't run the risk of outliving your savings. These are crucial objectives, and I think and if it is not done well in time, you will not have the time when you really start appreciating it, and time passes by.
Now we come to the fifth correction that you must do, and that pertains to something which is very plasticky.
The tendency to spend our future income, the easy availability of credit. When you go to, if you just do some window shopping and you come across a refrigerator, and your refrigerator is troubling you for an impulse purchase, and and you don't have the money, but you have the credit card, and then you have the friendly salesman who is telling you that even if you don't have the money, even if you don't have the credit card, installment interest free. That's the bait. Ask question yourself, that do you really need it?
Right.
Can you defer it? Because those are very tempting things. Don't always. And there are two things, when it comes to use any credit for any emergency. That's fine. I think credit card or taking credit for two things are justified. If you have an emergency, and the other is, buying a home, not the second home, the primary home in which you are going to live, which will save you rent, and you will pay the EMI. Make sure that your EMI is not going to be substantial. It should not guzzle all your income. So buying a home, an emergency, that is the only thing which justifies spending or mortgaging your future income today. Otherwise, all other temptations, try and resist, try and defer, because hidden or not hidden, hidden or even transparent, there is always a cost to borrow.
Right. So what Dhiren is saying, postpone consumption if you can't afford that. So the 5, if I were to summarize, Dhiren, not starting early enough. That mistake don't make. Second, your fixation on fixed deposit must go. Third, treating insurance as investment. Fourth, blindly following the advice of your friendly neighborhood
or
advisor.
falling for too good to be true, opportunities.
Yeah. And 5, buy today, pay later. That is, don't get into the credit card.
Yeah, and these 5 things, they look like they're very special Indian mistakes done by investor. No, it's a global phenomenon. Investors or savers worldwide fall for this. When it comes to these problems, this is a problem which is faced by in all geography, irrespective of the culture.
Cool. So get rid of these 5 mistakes, as Dhirendra said, for your lifelong financial prosperity. And of course, may the force be with you. Then time to move on to our second part of the program, and this is the Q&A part. And the first question we take is from Siddharth. He says, I have a lump sum of rupees 5 crore to invest. In how many mutual fund schemes should I invest? Also, what should be the time period over which I should spread the whole investment?
I think the second part of the question is more important. What is the time frame for you to invest your 5 crore? 5 crore is a very relative thing. If 5 crore happens to be your 2 years income, then maybe spread it over the next 1 year. If this 5 crore happens to be, your lifetime savings, it has taken a lifetime to save or accumulate, or it's a bonanza, or it is something which has come your way, which is unlikely, it is not a repeatable thing, then spread it over a 3-year period. Spread it over 3-year period equally, because that is the time period which we have realized where you are able to capture a full market cycle. So by spreading it over 3 years, you are able to eliminate the possibility of catching a market high. That is a huge de-risking exercise. How many funds to invest? There are multiple ways of looking at it. If you invest in 2 balanced funds, it will do the job. If you invest in 2 or 3 balanced fund, that will do the job, or 2 or 3 multi-cap fund, it will do the job. You will be because the goal with that investment will be that you should get exposure to everything. The advantage of a balanced fund will be that it will automatically be rebalanced. It will be automatically be rebalanced without the intervention of the investor, because balanced funds typically ensure a 70-30 equity and fixed income allocation, and that rebalancing happens at the fund level, so you don't have to do anything. Right. So that's the simplest way: 2 to 3 balanced fund, or else 2 to 3 multi-cap fund. That multi-cap fund will have will be little more volatile than balanced fund, but can potentially give more return. Then there is a third way of building a portfolio, which is you have 2 multi-cap fund, 1 mid-cap fund, 1 small-cap fund. 4th fund will get you a slightly larger, the portfolio will become more aggressive. When markets fall, this portfolio will fall more. But in a rising market, this portfolio over a 5-7 year period will will potentially give reasonably higher return. The reasonably higher return from a portfolio of if it's 5 crore and you have been through, but in building that portfolio requires that you need to do you need to really spread your investments over the next 3 years anyway. That apart, it is important, it is advisable only for investors who have experienced in markets or market linked investment at least for 3 years, because anybody who has not experienced market with any investment, whether it be a balanced fund or an equity fund or a sector fund or a tax saving fund, it is very hard to really absorb the shocks that the market gives with its rewards, because your investment plan gets derailed if you don't follow that.
What about the help of a fund manager or some person, financial manager or advisor?
Yes, financial advisor, but it's very hard to really evaluate a financial advisor. Finding a right financial advisor, we don't have too many of them. We don't have too many independent advisors, and so keep looking, keep asking the question, and what I'm suggesting you to do, only you can do it. Even your financial advisor can't really save you if you panic at the worst of times in the market. So all the heavy lifting has to be done by the investor. There is never a better guardian of your money than yourself. You have your best interest in your heart. Nobody else can match that. You can have a lot of people who will have your best interest, or they're configured in a way to serve you, but so get motivated to take care of your money yourself.
Yes. IC Garg writes to us, I have investment of rupees 15 lakhs in a liquid fund. I have lost substantial amount in the last few weeks. How is it that possible when liquid funds are said to be synonymous with saving account? What should I do?
They are synonymous with savings account, and
relevant.
Yes, and this has happened for the first time. Liquid funds never lost money in the past. The first liquid fund was launched in sometime in 1997, the Birla Cash Plus, and that was a pioneer in the category. We haven't had any occasion, one occasion when one liquid fund lost money, and that to few days return. And we haven't had a situation with liquid funds that they lost money ever. So for the first time, we find that there is one security, IRNFS, which has defaulted on the credit. It is not a substantial loss like equity, when it comes to equity. So liquid fund, this has been a very disappointing experience. The funds, there are many funds who have erred on the side of caution. There are funds which have not lost. They have not taken a poor credit. They avoided these securities, and they have done well. I think this is a turning point in the life of the investor's experience. And this came as a surprise. This came without, when it was least expected. And do you have anything to do? No, you can't do anything. In fact, I would urge investors that they have lost money in the liquid fund. Your fund is still holding that security. So don't take your money out. The loss was done in a very surprising manner, and that loss was about 0.5%. So I really wonder that, it ranged between 0.5% to 1.5%, but most of the bigger losses that we saw was in fixed maturity plans where you can't do anything about. In the liquid fund where this has happened, don't take your money out, because this happened, and this happened when the securities were marked down. Those securities are still lying there. When they are marked up, and if you take your money out, you will not benefit. You have been hurt by the loss, but you will not benefit from the rise. So don't take your money out if you don't need your money. If you need your money, which many investors will, and they have to, and they should, if you need your money for consumption, because liquid fund investments are not supposed to be long-term money.
So stay invested.
So, if you need the money, take it out, otherwise stay invested.
Okay. Anupam says, I have a capital of rupees 20 to 30 lakhs. Will it be wise to invest in equity using an advisory service? I think you did answer that in the first question.
No, he's asking a different question, that he wants to build an equity portfolio himself.
Okay.
And he has 20 to 30 lakh rupees. So yes, you have the threshold capital. In fact, the joy of building an equity portfolio.
I mean the advisory service.
Advisory service, equity advisory service. Two more things that is needed. 20 to 30 lakh, fine, good. You have the threshold money to use that service. Are you interested? Are you curious? Are you trying to look for answers, and the advisory service will provide you that answer? Do you have the temperament? That you'll buy those stocks even when they're falling, because you have the understanding and you want to build, because equity investing pays when you have the best, when you work towards building that conviction. Because most of the investors' risk come from not knowing what they're doing. So an equity advisory service which is helping you understand how things work, why they work, what is going on and why it is going on, that helps. So if you're curious, willing to understand, spend your time. So you need time, inclination, and you have the money, then go for it. Else, if you don't have the time, if you don't enjoy reading a corporate story, why a company is succeeding, why it is not succeeding, if you don't have interest in understanding that how the balance sheet looks robust but the profit and loss account is struggling, if you don't want to know these things, if you don't enjoy understanding how a business strategy has paid off and why it has not worked for, or why it is not working now, keep off from that. Mutual fund can actually get you all that with a very modest cost today, and if you enjoy it, go for it. The added joy of investing in equity with somebody's help is that it is one of the you also have great fun while you're making money.
And I must tell all our viewers that we have, if you see those books at the back, the stock exchange official directory, the whole directory is lying here. And if you want to ever
I would like
come
to give you a small background to this, Rajesh.
Sure.
You know, this Bombay Stock Exchange directory in the pre-internet days was the only encyclopedia of Indian companies. It had 20 years of balance sheet, profit and loss account, capital history, background on each and every listed company in the country. And this stopped getting published in 1997. So I think this is one of the last copies, last version. And I still have, I'm fond of this directory because for many companies, I like reading history. I want to know how Tata Steel came about, or how Thermax was started in Pune, how some companies started at what point, and what it led to. We come across all the companies which were British companies and the history documented here. Unfortunately, with the internet and with our focus on recency, it helps you understand companies, their history, where have they come from, their scale, and it still provides us great insight into the character and DNA of companies, because a lot of times we think that companies are stocks. No, they are made of people, and the kind of people, how they thought, why they thought so, and how they evolved a plan that translates into what Tata Steel is today, or what Grasim is today, or what many other older companies, old time companies are.
So this came about because Dhirendra advised you to read about the company that you're investing in, get deep into it. So we have a whole lot of information over here. So if somebody's around in Delhi sometime or Noida, you could see this valuable piece of information that's lying right behind us. Moving on, Neeraj asks us, and this is a question that a lot of investors would be asking, by how much percentage should I increase my SIP?
Neeraj, you have this answer. You have to answer this yourself.
But कुछ तो thumb rule होगा ना?
नहीं, कोई thumb rule नहीं है. अगर आप, if you are investing in, if you are doing your SIP, and next year you have this big expense coming your way, and you will not be able to save, make it zero next year. If you are going to get an increment, and if some of your expenses are going to come down, but I would say that the thumb rule, if you are asking for one, make sure that you are increasing your SIP to the tune of whatever be the percentage rise in your income. If you are making 50,000 rupees this year, every month, and next year you will be making 55,000 rupees, and of that you are making a 10,000 rupees investment. Increase it to 11,000, so that in percentage terms it still remains 10% of your income.
Okay. Dilip is the person who's written to us the next question. I want to invest in an index fund for a duration of more than 20 years. That's a good period.
Yeah.
Okay. Which index should I choose? Nifty, Sensex, or a combination of both?
It doesn't matter. I would say if you take it, because all the Sensex constituents are also in Nifty. Both are reasonably diversified. Sensex is reasonably diversified with 30 companies. I don't think Nifty is, better diversified with 50 companies. Sensex is just as diversified with 30 companies only. I think the important thing is that which is the vehicle should you choose? Should you invest in an index fund? Should you invest in an ETF? I think the Nifty ETF offered by, available today is the cheapest one. When it comes to investing in the index fund, go for the cheapest option, because what you get is exactly the same from anywhere, any fund company offering that. Okay. And the ETFs have the best ability to replicate the index with precision, and so go for the Nifty ETF and the cheapest one.
Can mutual funds deny redemption if liquidity is an issue, asks Navroz.
Yes, they can. There is a force majeure clause in with any agreement, and when you invest in a mutual fund, but we haven't had too many situations. There has been 2-3 occasions where occasionally it has happened when we have seen panic in the market, a lot of people queuing up to take their money, they can, but that is the end of that mutual fund. It leads to huge disrepute, and most fund companies, unless there is a systemic issue, that it happened in the US when 9/11 happened. The market opened after 3-4 days, and there was so for 3-4 days the market was closed. Likewise, in 2008 and 2011, there was an occasion when on one day some debt funds declined that, or unit 64 fall, it happened that investors were declined liquidity. But normal conditions, something extraordinary happens in the environment, they can. Otherwise, most funds don't, and they're well within their rights to do it.
Okay. The next question is from Kunal, and I'm going to divide it into two. First part, he says that he will shortly be moving to Canada. So can I continue to invest in mutual funds? That's part one.
Yeah.
Can he?
He can.
Okay.
But there are two ways of doing it. One is the illegal way of doing it, that don't declare to the fund that we have moved to Canada.
No.
And if the money keeps moving from your same domestic bank account, then it can. Your money can well lie there, what has been invested. But many fund companies are denying, because the FATCA rules of the US.
Okay.
And if you are going to be a tax resident of any other country, then you have to declare that. Some fund companies accept money from the Canadian citizens, tax residency.
Okay.
Some companies don't. So your options can get narrowed.
Okay, and the second part is, how is the compounding different in fixed deposits and mutual funds?
Compounding happens in fixed income. When you invest 100 rupee and you do a deposit, and it is compounded quarterly, so the 3-month return is added to your capital, and the next interest accrues on the interest added, so your capital has increased.
Okay.
In case of mutual fund, there is no compounding as such. We apply the formula because it is a capital asset. You bought something at 10 rupee, and a mutual fund becomes 12 rupees in 2 years' time. So you can apply the formula to figure out what is the return, but it is not compounding. Basically, you are buying an asset and the price changes over time. It is expected. There are certain kind of funds where the change in value is very much in line with, or is like that of fixed income, like liquid fund. It generates 7% return, and it is spread over 365 days. Okay. Or in case of another debt fund or a fixed maturity plan, it generates 9% and it's spread over 3 years. And so, it will look like, 27% or 29% annualized return, because the underlying is like that of a fixed deposit. But in case of equity, it's a capital asset. You have bought the ownership of a company. It is worth 500 rupees today, and in 2 years' time it can become 700 rupees, or it can become 350 rupees, or whatever. So we apply the formula to understand what the annualized rate of return is. It doesn't compound.
Okay. And Naveen says, I have more than one folio in a fund house. Can I merge them?
You can link them. So you will have a single paper. Merging folios, I don't know. It's a matter of technicality, and it doesn't matter.
Okay. Well, Dharan, thank you so much for answering all the questions of our viewers.
Thank you.
And that's all we have in today's program. But continue to pay attention to the advice that Dhirendra gave you about how to avoid the 5 mistakes that we tend to make, so that we can have a good long-term wealth in our portfolio. Signing off, I am Rajesh Lake. Take care of yourselves and keep investing. Bye for now.